Hey, Trader Stephen here with the TradersPlan.com. It is Friday, October the 1st, new month, starting the fall. We're going to start with the overall market, then we're going to look at some ETFs that are looking right. So let's start with the Nasdaq right here. There's really nothing good on this chart right here. You can see one leg, two leg. We don't know if we'll get another leg. But a couple weeks ago, I was talking when, this hit, like watch that pink line, that declining 20-day moving average, because a lot of times it'll come up and then get rejected, and that's exactly what happened. Now, it slightly closed above it by, 0.1% for a day or two, and then just got creamed. So, and like paying attention to where the market closes is the most important thing, because you can see the last 3 days, the market started up, or it started, in a different place, and then it's just closing at the bottom. All at, it's selling off in the final hour. If we go to the 60-minute chart of the Nasdaq, you can see right here what happened in the last hour of yesterday on Thursday. So look at all this distribution too, right? There is some unloading going on. I do believe that it's reasonable to assume that this 200-day moving average gets tested at the 14,000 level. Currently, we're about 3.6% above it. Now, will the market bounce back up and kind of find the crosshairs of the 20 and the 50-day and then get rejected again? I don't know, but it's easy to get sucked back in, right? You have some of these really strong bounces, but right now, just the market's looking ugly. So I would be incredibly patient and not try to play every little 2-3% bounce. The S&P 500, I mean, it looks the same, right? It tried to bounce and then failed, and now we're kind of hitting fresh lows. The futures are up a little bit pre-market, but they've been up the last 2 days in a row at the beginning of the day and then sold off. So we just really want to be cautious at this point. Especially with some more aggressive stuff, with some more aggressive names, they're going to get hit pretty good if the market continues to sell off. I want to show you this breadth chart right here. This is the percent. This box right here is the percent of stocks in the S&P 500 that are above the 200-day moving average. And you can see right here, this is definitely a secondary indicator, right? I don't make trading decisions off it, but a lot of times if the market keeps hitting new highs, right? This is the S&P 1500 composite. But if the market continues to hit fresh highs and then the breadth is just getting weaker and getting weaker and getting weaker, that's kind of an early warning sign. Now, just because the breadth is getting weaker, it doesn't mean I'm going to sell, because look, you follow price first, right? Instead of selling, right here, you can kind of sell right here as the market's starting to break. But you can clearly see what's going on right now. 66% of the S&P 500 stocks are above their 200-day. 50%, 57% of the mid caps, and about 59% of the small caps. They're doing a little bit better just due to the banks that have surged lately due to the rising interest rates. So, that really doesn't look good, right? But again, this really, it's not even under 60 at the moment. So we're just right now in a small correction. I don't even think we're in minus 10% territory yet. But so don't go freaking out or anything. But just kind of something to watch, right? This can turn at the drop of a dime. So we'll just really keep an eye on that. Let's go look at some ETFs. It's funny because the weekly list really hasn't changed much in 3 weeks in a row. You have, UNG, Nat Gas is still way up. I mean, this is quite a bit extended. I'm probably not going to get involved way up here. I mean, this needs to pull back quite a bit, and this is getting a little volatile, but UNG is up quite a bit, and the first Trust Natural Gas, FCG, you can see right here, is looking pretty good, but I would honestly wait for this to pull back, because you can see it broke out, and I think it needs to pull back a little bit because it's up like 8%, right, from this little breakout pivot right here. So it needs to pull back more into the, probably under 16 level for me to like that. You still have a lot of the energy stuff. So the IEO, which I do own this, and I booked partial profits on this, this broke out right here on this day, came back, you know, tried to shake me out, and then just resumed its uptrend. And I would believe this is going to pull back as well, because now it's kind of hitting these highs. Energy's pulling back a little bit. It had a nice, really week and a half move, 2 week move, and it's probably going to settle down a little bit. So if it does settle down, probably around like 55, that's where I'd really get interested in if you're not in energy yet. But something like this, this one's a little bit thinner. I think IEZ or even XLE. Yeah, see, this one broke out right here and is now probably going to pull back to the 50 level. So what I would just definitely pay attention to is a lot of the energy ETFs that have popped the last 2 weeks. I think they're about to give you another opportunity, because that's usually what happens, right? Something breaks out and, you know, gets everyone excited, and then it pulls back. It's going to test the resistance, or to see if it's now support, right? It's going to test this zone, and that would be an excellent opportunity to try to swing the bat and see if energy has, you know, a multi-month move. But just kind of looking at the chart, looking at all the energy charts, I mean, the evidence is there that the move is going to be longer, but we'll have to wait and see. You have to keep in mind that even though energy has has definitely outperformed the market, at the end of the day, if the market just comes under too much selling pressure, these are still stocks, and they probably won't hold up. So we'll keep an eye on that. Uranium, this is kind of interesting right here, because, you know, this went from 17 to 28 very, very quickly, and has really pulled back all the way to this zone right here, kind of this breakout zone. So this is looking pretty good. I would say if this pops, you know, if this pops at all, that could be an entry right there, and just put a stop loss under, right? You put a stop loss under yesterday, because if it falls back below here, it's probably coming all the way down to here, which would obviously be the ideal entry. So, but if it pops, you know, kind of gets out of here, then that's looking like that the support zone is tested successfully. So this very aggressive play right here is a nice retracement, and if it pops, it could be an opportunity. So just banks and energy, you know, you have the KRE that has moved up a little bit, and, you know, it can test this zone right here to see, right? Interest rates are down a little bit today, so these are just going to completely follow interest rates. So, but the breakout is real. I think this breakout is real above 60. I think the breakout is real with a lot of the individual banks. So I would just really pay attention to those. And if they do pull back and they give you a second opportunity, which, you know, I think they will. I think that oil and banks are going to pull back, and then they could pop again. So I think, you know, over the last 3 weeks, when banks and energy has been popping, get a little extended, I think they're going to pull back and give another opportunity, and that's completely normal. It's all part of the process. But look, rising relative strength line is looking pretty good. So let's see if there's anything on the 1 month. You know, strength follows strength, weakness follows weakness. So you can see it's really all just dominated by energy. There's one ETF that has been standing out, and I've highlighted this a couple times, and that's this travel stocks, and it's filled with Airbnb and Uber. This has been in a downtrend for quite some time, and you can draw this wherever you want, but if this breaks above that high right here, I mean, you have you could say, probably easily say it already broke out, but you have a little mini head and shoulders pattern, or inverse head and shoulders, right? You have the neckline, it broke out, hit the 200-day moving average. If you want to be probably conservative, which I think would be wise at this point in time with the market, you could enter as it breaks above Monday's high. But some of these stocks are looking strong. You can see there's buying coming in. This could be very, very early in the trend, so I'd keep an eye on this. But at the end of the day, just pay attention. Maybe make your trading decisions at the end of the day. All right. Sometimes in weaker markets, you probably don't want to buy a lot in the morning, because it tends to sell off in the afternoon. So I'm completely okay with paying a little bit more, waiting for the whole day to see if the market can hold up versus, you know, trying to buy in the morning and hoping that, you know, the market turns around. Because right now the charts, just about any way you slice and dice the indexes, I mean, that's looking weak right there. It is just completely looking weak, lots of distribution.